we're going to go through an actual client who saved or actually generated $974,000 of additional multi-generational wealth because of Roth conversions.
Retirement for life. Your passport to a comfortable and confident retirement. The podcast that's equal parts education and entertainment, where we break down the retirement maze with a dash of fun and a heap of wisdom from your host, Christian Sear CPA, the passionate retirement specialist and president of Sear Financial Wealth Advisors, the independent registered investment advisor specializing in the AIM retirement system.
Okay, retirement for life. Hi guys, how's it going?
Good.
Today is part 2 of Roth conversions. Andrea, on a scale of 1 to 10, how excited are you?
Definitely a 10.
Right there with her.
Okay. I like the enthusiasm. We said that Roth conversions were the single biggest opportunity for a generation of savers. I have said that for years. We have seen a lot of different educational videos, podcasts about Roth conversions. And frankly, I just didn't like any of them. And that motivated me to make this series on Roth conversions. This is the biggest item that moves the needle in retirement planning, okay? We talked in part 1 about what?
We were talking about the problem, the concept of the ticking tax time bomb and tax brackets, how it affects people, Social Security, their RMDs, Medicare Part B premiums.
We gave the
and
solution.
Worst of all, though,
Yeah.
the kids' tax bill.
Oh, right, the kids' tax bill. And we gave the solutions, right? If you
Yep.
do a Roth conversion, all those problems go away. We talked about, who generally benefits from this. And today we're going to talk about an actual example, okay? We're going to go through an actual client who saved or actually generated $974,000 of additional multi-generational wealth because of Roth conversions. Now, before we get going on this, I think it's important to not waste everyone's time, okay? I have said that Roth conversions are not for everybody, okay?
Yep.
But this particular person has saved a good amount of money, $2.1 million to be exact, okay? I think that he turned all of his money into tax-free money. His Social Security is getting taxed less. His Medicare Part B premiums are getting lower because of the Roth conversion. I mean, let's face it. What other strategy do we know of that will generate an additional, let's just say, $1 million for a guy who has $2 million? There isn't one.
No.
There isn't one. We're going to talk about that. To not waste anyone's time, really, I want to highlight the 5 key points that we highlighted in part 1, right? This show is not for everybody. Roth conversions is not for everybody.
Right.
Why are we talking about Roth conversions? You're saving $700,000, or I should say 6 or 7 figures in Roth conversions, okay? This is going to be what Ed Slott calls, what did he say, Austin, about, what was that called? It was almost malpractice for advisors not to be doing this.
Right.
If you have $1 million or more in a 401k or IRA and your advisor has not talked about Roth conversions, you are making a huge mistake, okay? So this is for people who have done a good job saving. Who are Roth conversions for? Those people, very clearly. What are Roth conversions? We're not talking about putting $7,000 a year into a Roth IRA. We're not talking about the backdoor Roth strategy, which can get you like $5, $10, $15, $20,000 into a Roth. We are talking about taking your life's work, all of it or most of it, and putting it into a different bucket called a Roth IRA.
Right.
How they work, very simply, you're putting stuff from pocket A to pocket B, and we'll talk about that. Now, here's the thing. Everyone's situation is different. This show today, if you are listening on iTunes, Spotify, whatever, this is a must watch. So you have to go to rflshow.com. I'm going to be doing a lot of drawing today. I want to show people. Nobody actually shows people in any of these videos, in any of these podcasts. I want to show our listeners, our watchers, exactly how this works. I want to go through the numbers. The benefit is not just for you. It's for your children also. Let's start by revisiting the ticking tax time bomb. How would you guys explain to our listeners what the ticking tax time bomb is and why all Americans are suffering from the ticking tax time bomb and they don't even know what it is? How would you explain this to the average Joe who's listening right now?
Simply, the ticking tax time bomb is your 401k or IRA that you have built up over years of working and now at your retirement? And then your second question was, how does it get to this point? I think, initial thought of advisors is to kick that tax can down the road and put it off and off so that this bomb just grows and grows and grows. And then eventually, it's got to go off.
Brandon, do you remember the gentleman that came in years ago and his wife almost punched me in the face?
Yeah.
Do you remember that?
Yeah.
They proudly walked in with their 401k statement, and they are customers today, but it looked bad for a while because they showed us their 401k statement, $1 million. I'm like, good for you, but that's not $1 million. I said, maybe at best you have $650,000. And she literally looked at me like she wanted to punch me in the face, the wife. And I explained to them, your 401k, your IRA has never been taxed.
Mm-hmm.
And the government is salivating, just waiting to get their hands on it. Why? Because the federal debt right now is $35 trillion.
Mm-hmm.
Currently in 2024, we are spending $1 trillion more per year than we have coming in.
Right.
What household do you know could spend an extra $1 trillion that they don't have every year?
No way.
Yeah.
Only the U.S. government. This is a problem. And so this ticking tax time bomb grows. We're going to show you that. I want to say that most people don't realize what this means to them until it's too late, right? Traditionally, I want to show you guys. When you have expenses, look at this. I want to show you. This is I would say an average retiree. This is how much they need. Austin, I've got $108,000 in the first year of retirement. They need to come up with $108,000. Now, what's this right here, Miss Brandon?
Social Security.
Social Security. Okay. So the first year they're like, I'm going to take my Social Security. I'm going to get 60 grand, but there's a shortfall here.
Yep.
Mm-hmm.
How do they make up for that shortfall?
From their savings and investments.
From their savings and investments. So this fictitious example, we got two buckets, right? These clients come in with two buckets generally. They have bucket number one and bucket number two. This is the buckets of money that they have. What's the difference between bucket number one and bucket number two?
Bucket number one, they've never paid, or they have paid taxes on.
They pay taxes on
And
it.
bucket number two, they have never paid taxes
Right. So an example would be, I've got $200,000. That's what I put in here, $200,000
on.
in an investment account. And I've got this 401k. My wife and I have saved up. There's another $1 million in there. Okay. That's typically how it goes.
Yep.
Bucket number one has already been taxed. Bucket number two, I got this nice little guy here, ticking tax time bomb. He has never been taxed, right?
Yep.
Okay, so the first year they get $48,000 they need because they've got a need here of $108,000. Where are they going to get the extra $48,000 from? Bucket number one or bucket number two?
Typically, people use bucket number one.
Mm-hmm.
You take the money out of here, bucket number one, because when you take the money out of bucket number one, generally it doesn't cost you any or very little taxes, right?
Yeah.
Mm-hmm.
If we're taking money out of bucket number two, it's costing us money, right? This is their taxable income. Pretty low, right? So people get this fake feeling of being in a low tax bracket. I'm not making money anymore.
Mm-hmm.
Mm-hmm.
I am now just kind of living on Social Security, and my advisors send me some money to make up the difference. And I feel good. I'm looking at my tax return. I'm in like the lowest tax bracket. I feel great. But what happens? This is the same fictitious client, but now I'm looking at age 75, age 95, age 85, age 90. Now, where is this shortfall coming from?
That's all coming from
Bucket number two.
Yeah, bucket
Coming
number
from
two.
bucket number two, and it's too late. They're now 75 or 85 years old, and now look at their taxable income: $133,000, $183,000, $218,000. This is the ticking tax time bomb,
Yep.
and I want to tell you more about it. All right, so let's review how to avoid the ticking tax time bomb. We gave this analogy in part one.
Mm-hmm.
I'm going to give the shorter version of it. You can pay $1 to get over the bridge at the beginning of the bridge. That's your toll. Or you can pay $3 on the back end. Okay.
Mm-hmm.
Most Americans go into the bridge thinking, just like, I'm in the 10% tax bracket. Everything's fine. I don't have anything to worry about, until they get to the end of the bridge and like, oh my gosh, now I have to pay a $3 toll.
Yeah.
People who do the Roth conversion are doing this $1 toll. They're paying money now, i.e. taxes,
Right.
so that they don't have to pay more taxes later. Very simply, that is what a Roth conversion is. Let's look at it in more detail.
Mm-hmm.
So, Brandon, tell me, what are people actually doing when they're doing a Roth conversion?
The simplest explanation is you're moving it from bucket A, which is your IRA or your 401k money, and
Yeah.
moving it into your Roth.
I
And
agree.
you're paying taxes.
Right. So it's like not free to move money from pocket A or bucket A to bucket B, right? Costs
Fortunately,
money.
no, yeah.
Costs money, right? But you're doing this for like some long-term gain. All right. Let's take a closer look. All right. So this is your timeline. You are 58. What are you doing right here?
Still working.
Mhm.
You are working. You are making money right here. And then you retire. Everyone's happy. As we showed you, you're not having to pay any taxes at all. Very little taxes, okay? So you're really happy here. And then what happens at age 70?
Start Social Security.
Yep.
Social Security starts and you're right back to where you left off. And what happens to Social Security every year?
Goes up a little bit with
Mhm.
inflation.
Goes up every year with a little bit of inflation. Now you're back to paying taxes, okay? But it gets worse. Why does it get worse when you turn 73?
As you start your RMDs.
RMDs. You are forced now to start. The ticking tax time bomb is about to begin to explode because not only are you getting Social Security as taxable income, your RMDs are coming in. Do you need all those RMDs generally?
No.
No, but they're forcing you, and now your taxes are going through the roof. Now you're in this high tax bracket. Okay, what happens, Austin, when you die and you still got $1 million in your 401k?
Yep. Now your kids are forced to pay that. tax.
Now here is where you're at. Okay, I want to show you something. This is the ideal time to do a Roth conversion. I call this the Roth Valley. Okay. What you're doing with Roth, there's nothing you can do while you're working, but now you're actually increasing your taxes here. And now at age 70, what do? For the rest of your life, you're in this low tax bracket because you did a Roth conversion.
No more RMDs.
And what happens now when you die with $1 million in your IRA?
Your kids
Kids.
inherit it.
Yep. Tax free.
No taxes for the kids. Okay. I love that. Here is what you save by doing a Roth conversion. Okay. Yes, you have a little extra taxes here. For 5 years, you pay the piper. That's I would call this year's your $1 toll if we're using the bridge analogy.
Right.
And this is you paying 3 or 4. That is the analogy. That is a Roth conversion. So let's go to this actual customer. Okay. I'm going to call him Jim. Don't let me call him his real name or we'll have to start over.
Okay.
So what happened? What's going on here? This green line is him doing the Roth conversion, as we explained to him. This red line is him not doing a Roth conversion.
Right.
First questions first. Red line, no Roth conversion. What is this spike right here?
That's when they pass away and the kids are paying their taxes.
Mhm.
Right? Okay. Another thing to point out about Roth conversions, be very clear about this. Some people cannot handle this. What do you notice right here?
Paying taxes
Yeah.
up front.
You notice that if you do, this is the lifetime of income taxes paid, federal income taxes paid.
Mm.
Okay. You are paying more here. This is what I call short-term pain. Ouch. You're paying more taxes here. But right here, the difference between not doing a Roth conversion and doing a Roth conversion for Jim was over $1.1 million. $1.1 million. Short-term pain, long-term gain. That is what a Roth conversion is. Let's start looking into the details of what this actually looked like for Jim, okay? According to a recent study, the average American feels like they need nearly $1.5 million to retire comfortably. That's a 53% increase compared to the same study just 4 years ago. But is that the right number for you? And are you doing everything you can to maximize your financial situation? The AIM Retirement Assessment can help you figure that out. This free assessment is a simple 3-step process. Answer a few questions about yourself. Spend 15 minutes discussing your situation with one of our retirement specialists, and then we get to work. You'll receive a customized report. detailing your exposure to the 7 biggest risks in retirement and the 3 most impactful action items you can take to supercharge your retirement. And if you already have a financial plan, this assessment will help you see what real retirement planning looks like. Get your AIM assessment today and see the difference between a financial generalist and a retirement specialist. Go to aimassessment.com today to get started. That's aimassessment.com. All right, give me a breakdown here, Austin. Tell me about this guy, Jim, and his wife. How old are they?
So they are 55. He wants to retire at 58. Planning our average annual return around 6.1%. I'd say that's pretty typical, net after fees. And then starting their Social Security at 70 for him, and then for his wife at 67. And then finally adding that mailbox money portion that we've talked about in previous episodes.
Brandon, real quickly, why did we allocated, it looks like 25% of his nest egg to mailbox money. Why did we do that?
That's our typical target so that it helps with their income stability in retirement.
All right. So his income is not dependent on the stock market. So this is basically him going through the AIM retirement system, okay? We've picked the right portfolio, we've optimized Social Security, and we've optimized income stability by adding that Social Security 2.0. At this point, Jim has a 100% chance of retirement success. At this point, we could send him out of the building and he would be happy, okay? But then we start talking about Roth conversions, right? I want to give you an idea of how much money this guy spends, okay? He's not a frugal person, but he's also not spending a lot of money. Let's look at his expenses to give people an idea of what type of person this 55-year-old guy is and his wife. Let's take a look. All right, so in year 1, Austin, how much is Jim spending per month?
Just under 10,000, about 9,600.
Okay. And that breaks down between living expenses, housing expenses, right? Property taxes, insurance, a little bit of maintenance, and then, of course, healthcare. We're planning for that. Let's fast forward 23 years. We look at Jim's retirement. Now his budget has gone up to how much?
Just above 14,000.
All right. And Andrea, when people see this, their living expenses going from $7,600 to $9,300, what do people usually say?
They say, no way I'm spending that much money at 80 years old.
They have no concept of this thing called inflation, right? This is actually, his expenses are actually decreasing 2% a year as he gets older, okay? It actually looks like it's going up, but inflation, if it's 3%, he's actually decreasing his expenses 2% a year. I would say this is pretty average for our retirees. All right. So you got a guy who saved up $2.1 million. He's identified the right investment strategy. He's identified the right mailbox strategy. He also has optimized Social Security. And now we start talking about Roth conversions for a guy who spends about $10,000 a month. What's this look like? So what's the first thing we show him? I'll say it again. So we show him what his taxes would look like at age 80. So what's the first thing we show Jim?
We're going to show him what his taxes look like at age 80.
Yeah. And this is often where people start turning the corner and really, truly understanding the benefits of a Roth conversion. Okay. This first column right here is him not doing a Roth conversion. Jim, if you do not do a Roth conversion, your taxable Social Security is going to be $121,000. You have that other income. And what is this?
They're RMDs.
What is an RMD? Just remind us again, why are we taking $109,000 of RMD at age 80?
It's a forced distribution from the government that you have to take out.
Ticking tax time bomb. The government says you have to take $109,000. Does he need it?
Nope.
No. Most of it he doesn't need. He's got $121,000 of Social Security and another $46,000 of other income. The last thing he needs to do is start the ticking tax time bomb, but he's forced to do that, okay? I show Jim your taxable income on your 1040 tax return at age 80 is going to be $248,000. You remember when I showed you high tax bracket? That's exactly what happens. The guy's paying $44,000 of federal taxes at age 80. But hey, what if you did a Roth conversion? What if you paid the dollar toll a long time ago and you don't have to pay taxes again, or not a lot of taxes? Point number one, your Social Security gets taxed less. He's not getting taxed on $121,000. You're now getting taxed on $78,000. How much is his RMD now?
Nothing.
Zero. And here's a real benefit here. I want to talk about this for a second. Okay, we're CPAs, so we're doing our clients' tax returns through this process. You generally get deductions, right? Americans love to write stuff off. You have, because you're making less money, the government says, hey, you're making less money, we'll let you write more off. So his taxable income by doing a Roth conversion goes from $248,000 to $84,000. In 1 year, at age 80, he is saving $32,000, $33,000 of federal income taxes.
Yeah.
That's if taxes don't go up in the next 30 years,
Exactly.
Yeah.
20 years, whatever. Okay. I would argue that this picture, when he actually turns 80, 23 years from now, I'm going to argue with you that probably tax rates are going to be higher and his savings is going to be better, right? Go back to the bridge analogy. You paid $1 at the front. You never have to worry about taxes again. Or you have to pay $3 at the end of the bridge. Well, what if you get to the end of the bridge and Washington, D.C. has said, we've changed our mind. We need more money. Now the toll at the end of the bridge is not $3. It's now $4, okay? He might save more than $32,000, okay? That's just
Probably
1 year.
will.
Just 1 year. So let's go through the actual results of what Jim did and what we showed him he could do and why he chose to do a Roth conversion. Okay. This is the amount of federal taxes he will pay over his lifetime if he lives to age 90. Okay. From ages 58 to 90, that's basically his retirement. He will pay $1 million in federal taxes if he does not do a Roth conversion. But if he does a Roth conversion, Austin, how much is he going to pay in federal taxes instead?
Almost half, 552,000.
He is saving over $500,000 in federal taxes over his retirement by doing a Roth conversion.
Yep.
Let's look at it past him. Let's look past the grave and let's see what else this means. Now it's at age 90, it's the end of his life, okay? Whether he does not do a Roth conversion or he does do a Roth conversion, either way, he ends up with about how much money in his bank accounts?
Over $4 million.
But you notice the difference. This right here is the account, the ticking tax time bomb. Over his lifetime, it just got bigger, okay? But by paying off the taxes early, doing a Roth conversion, what you told us earlier, Andrea, you take this money in a Roth conversion and you shift it to this bucket right here, the Roth bucket. So by doing a Roth conversion, all of his money is sitting in a Roth account. And this money right here, what happens to this money when he dies?
Those are the kids. They pay taxes on it.
And look at these kids, these poor kids pay $682,000. Oh, that should be a sad face. Pay $682,000. So at the surface, it looks like this Roth conversion really didn't do him any good. Either way, you got $4 million, but really, what really happened? This is an extra $1 million added of multi-generational wealth.
Yep.
Now, I often say to people, when you're making this Roth decision, you have to understand that part of this is going to benefit you, and part of it's going to benefit who?
The kids.
The kids. What's that look like? So here's that $1 million we were talking about right here. I'm breaking this down for people, and we do this for all our clients. We're like, look, when I say you're going to add $1 million of multi-generational wealth, multi means more than one. Right? So how much money is Jim and his wife going to save? Now, we already saw that he is saving $500,000 in federal taxes. Tell me why he's going to save $73,000 of Medicare premium, Part B premiums over his lifetime.
When you have lower taxable income, you pay less on your Medicare premiums.
Say that again.
When you have lower taxable income, you have lower Medicare premiums.
Remember we showed you at age 80, his taxable income is not 200 and something. It's much, much, much lower. Therefore, his Medicare Part B premiums are also lower.
Yep.
Not only is he saving on federal income taxes, he's saving on Part B Medicare premiums.
Yep.
Now, this line we haven't talked about yet, but this is an interesting line. Reduced advisor fees. Why is he paying reduced advisor fees over his lifetime?
Because we get a fee based on the assets we manage. So we're essentially telling you to send that money to the government, therefore lowering the assets we manage,
Right.
and our fee is lower.
Right. When you're paying $1 at the beginning of the bridge, what happens to your overall portfolio? It goes down, right? And so therefore the fees are lower. Now your balance is lower. You're also earning less money in the stock market. But he is basically, overall, he and his wife are going to save $300,000 in their retirement by doing this Roth conversion. And how much taxes is are his kids going to pay because he did a Roth conversion? None.
$0.
None. So his kids are saving an additional $700,000 in taxes that they would have to pay. And that is how you save $1 million by doing a Roth conversion. Is this example a crazy example? Is it like in far left field?
It's very typical.
Yeah.
This is typical. Just yesterday, we had somebody who saved, how much did he save on his Roth
I believe
conversion?
it was almost $4 million.
It was like $3.6, $3.7 million.
Yeah.
Okay. It just depends. Again, if you have $400,000 saved up in your lifetime, the Roth conversion probably isn't going to make a lot of difference for you. It might even hurt you. I think right now, sitting here in 2024, that Roth conversion, the difference is that the tipping point is at $700,000. When I see somebody who has investable assets of $700,000, that's where that Roth starts to make sense. I went back. We talked about this in the first part. You know, Austin, you went back and pulled close to 200 actual Roth conversions. The numbers are basically like this. If you have $1 million of investable assets, you're probably going to create on average about $500,000, 500,000 bucks of additional multi-generational wealth. If you have $2 million, you're generally going to create another $1 million. And that's the example I showed today. If you have $5 million, it's going to create an additional $2 million of multi-generational wealth. And so for me, Roth conversions are, I'll say it again, the single biggest opportunity for a generation of savers. Advisors not necessarily talking about this because A, they're not CPAs. Their favorite terminology is go see your tax advisor. It's a complicated strategy. It's hard if you don't know all the moving pieces. They're also basically saying, why don't I charge you less fees? I'm going to give you a strategy that not only makes you more money, but it makes me less money, right? This is something that you need to talk to a top tier level 5 advisor, a person or a firm that not only has financial planners, licensed financial advisors, but has a CPA or CPAs on staff that are working together because this is a complex strategy. Okay. I believe Ed Slott was right when he said that the average American with a bunch of savings does not realize that he or she is sitting on a tax time bomb. I believe that. Most people, when we start talking about this Roth conversion concept, it's a foreign thing to them. It's also scary because you are paying taxes. The day you retire, you continue to pay taxes. But in the long run, the savings, the creation of multi-generational wealth is unarguably significant. So in part 3 of the Roth Conversion podcast, we're going to talk about logistics. So feasibly, somebody has listened to part 1. They understood why we're doing Roth conversions. They understood the reasons why, the real problem that exists with the ticking tax time bomb. We have now gone over an actual example and showed how you can, and because when you say you can save or create $1 million of additional wealth, I think people scoff at that. How can that really be? After watching this part 2 today, you can see how it happens. Okay. We saw Jim saving $35,000 a year in taxes over the course of his 30 plus year retirement. Right there, that adds up to a lot of money. Okay.
Yep.
You can see how his Medicare B premiums have been reduced by $74,000. You can see how he's paying less advisor fees. And it just makes practical sense that if I give my kids a ticking tax time bomb, they are going to pay the piper. And with a Roth conversion, they don't do that.
Yep.
After you start to add up the numbers and you see visually that you, if you do not do a Roth conversion, will probably be in that high tax bracket. And if you do the Roth conversion, if you go forward with it, you're going to be living this nice little happy face, low tax environment life for the rest of your retirement. And your kids are going to get this money tax free. Part 3, we'll talk about the logistics. So you've watched part 1, you've watched part 2. Now, if you really are interested and you want to see more, next episode, we're going to talk about what does this actually look like? How does it work when you pay the taxes? What's the logistics of this? If I'm putting money, how much do I put in every year? How does it work? And how do my Medicare Part B premiums actually go down? We'll walk through the logistics, kind of get in the mud, get into the dirt about what this really looks like for a person who is seriously wanting to know more about Roth conversions. I think personally, if I had saved $1 million or more in my 401k, and I had just watched part 1 and part 2 of Retirement for Life Roth conversions, I don't think I'd even watch part 3. I think I would just go straight to a level 5 advisor and say, where do I sign up? But for those people who want to know more, we'll do that in part 3. I want to say that we are now up to 511 subscribers on YouTube. When we started this journey, we were like at 20, 25, I don't know, maybe 30. And in less than 6 months, we've gotten over 500. And I think now, Brooke, I think we can get up to like 1,000 or 15. Yeah. What do you think is a reasonable target for end of year YouTube subscribers for the Retirement for Life show?
I'm going to say 1,000.
Go to rflshow.com and hit the subscribe button. That is the only thing we are asking you to do by taking in this, I think, engaging content, fascinating content. And you said it. We rated this topic as a 10 out of 10. I mean, I just showed people how to save $1 million. Mm-hmm. I think it's the best way to go. Thanks for watching YouTube. Thanks for participating in Retirement for Life. And we'll see you guys next time. Part 3, Roth conversions. That's in 2 weeks. See you then.
Investment advisory services provided by Sear Financial, Inc., SEC registered investment advisor. All content on this podcast is for information purposes only and should not be considered investment, legal, or tax advice. Material presented is believed to be from reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness.